He's David Tice, founder and fund manager at David Tice and Associates, and joining us from Dallas this morning. Hi, good morning there, David.
Glad to be here.
Well, before we get to your very certain predictions on recession, I do want to get your reaction to what's going on in the markets right now. What is really driving investors right now to sell, or is it just momentum selling going on?
Well, we think there is a recognition, Betty, that there's been a train wreck right in front of our house and that they're carrying the bodies out. The credit markets are in complete, catastrophe right now. The CDO market is unraveling. The asset-backed commercial paper market had the biggest decline last week in the last 2 months. Things are falling apart, and the equity market has been like a boiled frog. It stayed up. However, people are realizing they're getting, boiled.
Well, what's the trigger, David? I mean, what's got people suddenly realizing it now?
Well, I think it is slowly sinking in. There's some of these senior tranches of CDOs that are facing accelerated status of default. They are forcing liquidation of the underlying securities. There's been a downgrade of 12 notches of a major CDO recently. And the big write-down sheet, we've had Merrill Lynch and Citigroup both have their chairmen resign. This is significant.
Indeed. David, we've only got about 30 seconds or so, but I want to get your take on how much lower you think the markets can go right now.
We think that the markets can decline 50 or 60%. We hate to say something so somber, but it's not the time to be optimistic or pessimistic. It's time to be realistic. Our whole system has been built on credit expansion. We have to grow credit year over year in order to keep the economy growing. The economy is not going to grow. It's going to suffer recession, and once it enters recession, it's going to cascade on itself.
Let's get more with David Tice. He is the fund manager of the Prudent Bear Fund. Hi, thanks for coming back on our show, David. I've got to ask you, your fund says it all. You're a bear fund, so certainly you would be more negative on the markets as well as on the economy. You say that we are 100% headed for a recession. We just had Alan Greenspan earlier this week saying that the chances are less than 50%. So what do you know more than Alan Greenspan?
Okay, let me start by saying that we are bearish. I started this fund because I was bearish, so it's not that I'm bearish because I started this fund. I started this fund with my own money 10 years ago. I felt like we were entering a credit bubble that investors needed to hear the other side because Wall Street was out telling people to buy stocks forever. Wall Street told people to buy Amazon when it was $400, et cetera. So I am bearish, but bearish because I care and I believe I understand this. As far as what I understand that Greenspan doesn't understand, I think Greenspan understands this, but he doesn't want to go on record and say something like this. I do believe that credit expansion has been the key to growing the economy. I understand credit bubble dynamics, and credit is being tightening right now. There is no doubt about that. And we have had a breakdown in structured finance. Structured finance is no longer functioning. And with that, we have housing prices in dramatic decline. The consumer is facing $95 oil. We had import prices up 9.6%. Therefore, we are going to enter a recession, in my opinion.
Do you think we're already in a recession?
I think we are likely in a recession. If we're not yet, it'll be that way in a couple quarters. The consumer, there was a survey in the Boston Globe that said Christmas expected spending was to be down 19%. Therefore, we've had companies like Nordstrom's, Samuel Adams Beer, Smith & Wesson, all these kind of consumer discretionary companies are slowing down. It's in the cards. It's happening.
And David, you say we're seeing some dramatic credit bubbles, but could not the Fed do something to prevent a huge or enormous popping of this bubble?
We don't think so. The Fed screwed up, in our opinion. Henry Kaufman, legendary credit authority from Salomon Brothers, spoke at our symposium 10 years ago, and he said the Fed has missed its timing. We think that at this point you have to, I'm not sure what to do today. The Fed should have not kept interest rates so low in the past. We should have experienced some mini recessions along the way. Right now, the bubble has gotten so big. We've had a massive credit bubble globally. It's entered real estate. It's entered every, aspect of finance that is going to be very, very traumatic.
Now, David, earlier you talked about the markets going down about 30 to 50%. What groups do you think are headed for a steep fall?
Yeah, I said 50 to 60%. I think that financial stocks are going to continue to decline. Technology stocks have been, okay for a while. Now people are fleeing them because they've been viewed as a safe haven. They're not going to be the safe haven.
Right.
As Cisco said, these companies are still dependent upon enterprise spending,
Right.
and banks and big companies are going to spend less.
Right.
But consumer discretionary stocks are going to go down a lot. A number of stocks are going to go down. It's
Right.
going to be pervasive.
Okay, thank you very much, David. We're just out of time. That was David Tice, fund manager at Prudent